The consumer financial system has conditioned you to treat a high credit score as a personal badge of honor, an absolute guarantee of your banking credit worthiness. You spend years micromanaging your utilization, paying balances down to zero before the statement dates, and monitoring a colorful dashboard app on your phone, expecting the world to open up when you hit a 750. But when you finally step out of the consumer retail sandbox and request an enterprise business line of credit or a premium corporate card, the entire illusion shatters. You press submit on the application, and within 400 milliseconds, a cold, automated rejection notice flashes across your screen. A human underwriter never even looked at your name, your pristine score, or your clean payment history. The machine learning algorithm executed a preemptive data strike on your profile before your packet could even clear the bank's security gate. Over the next 20 minutes, we are going to dismantle the hidden architecture of the banking matrix to show you exactly how the system operates when your dashboard says you are perfect, but the bank's private scoring grid flags you as an unmitigated liability. By the time this breakdown concludes, you will understand the precise configuration required to bypass the automated filters and force a programmatic approval override. When you receive an instantaneous automated denial, your natural instinct is to assume a human loan officer reviewed your debt ratios or verified your income structures. The reality of modern institutional lending is far more mechanical and cold. Tier 1 financial institutions process tens of thousands of applications every single hour using an asynchronous processing matrix. The moment your digital signature hits the server, your profile is routed through a series of automated gateway filters designed to test for data anomalies rather than financial stability. If the system detects a single mismatch between your formatting and the core bureau registry, the logic gate shuts down instantly. The 400-millisecond filter is not assessing your ability to pay back capital. It is scanning for pattern disruptions. You are playing a game based on trust and morality, while the bank is running an automated probability engine that treats your everyday consumer habits as high-risk anomalies. To break out of this loop, you have to stop looking at your credit file as a scorecard and start managing it as raw data infrastructure. To understand why the system feels fundamentally broken and unfair, you must examine the history of the consumer credit score itself. The personal finance industry engineered the public three-digit score to serve as a gamified pacifier for the masses. It was designed to keep the average consumer hyper-focused on maintaining stable, predictable, high-interest retail debt loops that generate massive interchange revenue for the issuers. The dashboard apps you monitor daily are not looking at your profile through the lens of capital distribution or enterprise leverage. They are grading your ability to remain a compliant, profitable retail slave to small-limit revolving cards. The moment you attempt to leverage your profile for true commercial capital, the retail rules are completely discarded. The institutional risk grid operates on entirely different parameters that are completely hidden from your consumer interface. You are trying to navigate a high-stakes corporate vault using a map designed for a children's amusement park. The contradiction deepens when you realize that the behaviors celebrated by consumer finance apps are often the exact triggers that cause an institutional machine learning engine to flag your file for immediate restriction. You are told that carrying a zero balance across every single account is the ultimate signal of fiscal responsibility. You scramble to clear every statement, presenting a completely immaculate, debt-free profile to the bureaus. But when that data packet hits an institutional underwriting engine, the machine does not see safety. It sees an untestable data void, a state of total operational dormancy that makes it impossible to calculate your real-time risk trajectory. The algorithm looks at your absolute zero balance and concludes that you are either hiding a structural liquidity deficit or completely isolated from the active velocity of the market. Your play for safety inadvertently triggers a defensive security protocol inside the bank's core network. To bypass the automated gatekeepers, you must pull back the curtain on the private data networks that Tier 1 lenders actually query before they ever check a public FICO bureau. While you are obsessing over your Equifax, Experian, and TransUnion files, the institutional mainframes are quietly pulling deep background reports from secondary data repositories like SageStream, Innovis, and LexisNexis. These secondary data brokers act as a shadow registry, compiling an unregulated, volatile stream of your transaction frequencies, identity tracking variables, and historical utility records down to the exact millisecond. If these shadow repositories contain a single unverified address, an old employer listing, or a misspelled name variant, your primary credit file is instantly flagged for identity instability. The Tier 1 algorithm cross-references the public data against the shadow data, and if the layout formatting fails to align perfectly, the machine hits your application with an automated rejection notice before a human underwriter can even glance at your profile. The core technical engine behind every automated rejection is the proprietary relationship scorecard that each individual megabank maintains internally. Lenders like Chase, American Express, and Bank of America do not rely on your public consumer credit score to determine your capital allocation. They compile their own internal rating matrix based on your historical deposit density, your capital velocity, and your account interaction history within their specific vaults. If your internal relationship score with an institution sits at absolute zero, an outside 800 FICO score will not save you from a low-limit restriction or a flat denial. The bank's predictive engine is seeking to maximize its internal ledger revenue, and if you do not feed their internal deposit ecosystem, their automated system will preemptively choke out your credit capacity to preserve capital exposure for active relationship profiles. Another hidden variable within the automated decision engine is the concept of data latency and asynchronous reporting delays. You might make a strategic payment to optimize your utilization file, watching your consumer dashboard update with a positive notification. However, inside the credit bureau mainframes, your updated information is batched, processed, and cached on an asynchronous timeline. If you submit a major funding application during this data latency window, the live query pulled by the bank will read your legacy data footprint rather than your newly optimized profile. This creates an immediate product layout mismatch inside the algorithmic gateway, triggering an automated denial because your real-time data velocity appears unstable or erratic. You cannot force an institutional approval if you are blind to the exact timing windows of the data broker networks. The machine learning models used by modern financial institutions do not evaluate your credit profile in isolation. The absolute second your application packet enters the system, the core algorithm runs a predictive simulation that automatically pairs your individual file with a distinct statistical cohort of data peers. If your mathematical markers line up even slightly with a consumer group that is currently experiencing a high rate of default or financial distress under prevailing macroeconomic conditions, the system will preemptively restrict your borrowing limits or reject your application entirely. You are being judged and penalized based on the macro behavioral data of complete strangers who happen to share your geographical or transactional footprint. To break free from this cohort dragnet, you must structurally modify your non-score variables to force the system to categorize you into a prime institutional tier. The institutional matrix monitors more than just your balances and timelines. It tracks the explicit behavioral metadata of your capital deployment. Every single transaction you execute streams a specific 4-digit merchant category code directly into the bank's predictive underwriting engine. If you consistently route your capital through subprime financing channels, secondary point-of-sale payment portals, or cash advance networks, the machine flags your file for active cash flow distress. It does not matter if your payment history is absolutely flawless or if your consumer score sits in the high 700s. The predictive algorithm interprets those specific merchant metadata paths as an emergency search for survival liquidity, lowering your internal risk rating and triggering an automated limit haircut across your entire banking ecosystem. When an institutional underwriting system processes a fresh application, it immediately runs a geographic cross-reference protocol against your registered billing footprint. The core algorithm overlays your data trail with localized regional census tracts and shifting macroeconomic indices. If your stated corporate revenues or personal income streams do not mathematically align with the average economic performance profiles of your specific zip code, the machine senses an anomaly. To protect its capital exposure in a contracting regional market, the automated engine executes an immediate, preemptive income haircut to your file, slashing your requested limits by up to 50% without ever requesting a physical pay stub or tax return. Your physical location is actively dictating your access to institutional leverage. The real reason credit feels like a completely rigged game when you are trying to act responsibly is that the system is fundamentally engineered to interpret traditional retail consumer behavior as a financial risk. The banks are not looking for citizens who are completely debt-free and disengaged from the velocity of money. They are looking for highly predictable, stable data loops that can be easily modeled by an automated risk grid. When you fluctuate wildly between carrying a balance and plunging down to absolute zero out of a desire to look responsible, you break the machine's predictive continuity. The algorithm views that rapid shift in data velocity as a volatility spike, and the default response of any automated lending engine faced with an unmodelable anomaly is an immediate, programmatic denial. The corporate banking infrastructure operates on a real-time search frequency matrix that monitors the velocity of your outward data queries down to the exact millisecond. If you scatter multiple credit inquiries across a short timeline, assuming a few weeks of spacing will shield your file, you are falling into a fatal timing trap. The asynchronous reporting cache aggregates those queries during live institutional pulls, flashing an active risk alert across the grid. The machine reads that concentrated data velocity as an emergency liquidity crunch, signaling that your operation is actively burning through capital and desperately seeking an institutional life raft. The system closes its gates right when you require the leverage most because your outward data trail signaled panic to the machine. To dismantle the automated gatekeepers permanently, you must understand the underlying data transmission standard known as Metro 2 compliance. Every single piece of information reported to the credit bureaus by debt collectors, mortgage companies, and credit issuers must be formatted according to strict computerized layout rules mandated by federal consumer law. The vast majority of negative line items, collection accounts, and payment defaults are input into the bureaus using outdated, corrupted software templates that contain massive formatting omissions and algorithmic errors. When you blindly send money to a collection agency assuming a zero balance will fix your file, you are leaving those toxic, corrupted layout structures completely intact within your history. Paying off an old, dormant collection account without executing a complete structural data purge is one of the most devastating tactical errors you can make. The moment your settlement payment clears, the collection agency transmits an updated status packet to the primary bureaus. This process instantly reactivates a decaying negative item, dragging it from the historical archive directly to the front of the real-time search frequency matrix. The algorithm reads the fresh update code and treats the old default as a brand new financial crisis, causing your score to plummet and freezing your institutional funding access. You must learn to attack the compliance layout of the data file itself rather than negotiating with the collector. The credit reporting system is not an objective record of your financial character. It is a highly profitable commercial data harvesting network that monetization engines use to profile your consumer habits. The major bureaus make billions of dollars selling your real-time risk markers, and transaction data leads back to Tier 1 lenders and subprime marketing agencies. This is why the sandbox is designed to keep you trapped in a perpetual loop of tracking small score fluctuations on a mobile app. As long as you are focused on chasing the illusion of a perfect retail number, you will never take the structural steps necessary to audit your backend repositories, secure your secondary files, and command actual institutional leverage. When you attempt to clear a legacy default or an invalid inquiry from your bureau profile, the system does not route your dispute to a human investigator. Your legal correspondence is scanned by an automated optical character recognition engine and converted into a simplistic three-digit code inside a centralized network known as eOscar. This automated system strips away all your context, your legal evidence, and your personal explanations, reducing your financial dispute to a machine-readable variable that is batch-processed in seconds. If your data layout does not match the precise Metro 2 compliance standards required to force a system deletion, the automated engine will simply verify the toxic item and lock it onto your profile permanently. Now that we have completely decoded the hidden engineering of the banking risk grid, we must lay out the definitive step-by-step tactical manual required to optimize your data architecture for high-limit enterprise capital. The very first action item in your structural overhaul has absolutely nothing to do with your public payment history. You must execute a comprehensive identity data purge directly across the 3 primary bureaus and the secondary shadow repositories. You must systematically remove every single variant name spelling, outdated employer listing, and legacy residential address historical file from your background registry, leaving exactly one clean, verified data anchor matching your current digital legal signature. Once your foundational identity formatting is locked into a single perfect registry alignment, your second tactical maneuver is to execute a total administrative lockdown on your secondary bureau files. You must contact data brokers like LexisNexis, Innovis, and SageStream to formally freeze your tracking reports. By severing the communication pipelines between these shadow repositories and the primary credit networks, you instantly eliminate the volatile transaction history and tracking gaps that the Tier 1 algorithms use to trigger automated rejections. This isolation play forces the bank's machine learning model to evaluate your profile based solely on your clean primary data layout, stripping the engine of its subprime variables. The third phase of your institutional configuration requires you to stop playing the zero balance game and implement the single-digit reporting protocol across your active revolving lines. Instead of clearing every account to absolute zero before the statement dates and creating an untestable data void, you must allow exactly one primary card to report a minimal utilization ratio of roughly 1%. This deliberate data input provides the automated underwriting engine with the precise transaction velocity signal it requires to run its stability simulations, demonstrating that your file can actively carry and clear capital without triggering a cash flow stress alert inside the risk matrix. An automated denial or a frozen credit limit is never a personal failure or an indictment of your financial intelligence. It is simply a cold, mechanical product layout mismatch between the variables on your profile and the real-time capital appetite of the institutional banking grid. The machine has no emotion, no intuition, and no memory. It simply processes the inputs you feed into its interface. The moment you step out of the consumer retail sandbox, cease chasing superficial dashboard points, and begin managing your profile as a compliant piece of data architecture. You force the system to execute an immediate programmatic approval override. Take control of your data trail, stop playing by their rules, and command the vault.